There's a number almost nobody in financial media talks about when they cover China's tech sell-off. It is not the percentage drop in Alibaba's share price. It is not Tencent's earnings miss. It is a single line from a Bloomberg Intelligence report published in June 2026. Mainland Chinese investors sold a net $460 million worth of Hong Kong-listed shares in May alone, the first monthly outflow through the Stock Connect program since June 2023. When Chinese investors themselves start pulling money out of Chinese tech stocks, something has fundamentally shifted. This is the story of that shift, and it is bigger than a bear market. To understand what is happening, you need to go back to October 2025. That was the peak. The MSCI China Index, the benchmark that tracks China's biggest companies listed in Hong Kong, was near its highest point in 2 years. Investors had returned after months of stimulus optimism, a partial trade truce, and excitement around Chinese AI models like DeepSeek. By June 2026, that index had dropped 18% from its October high. For a benchmark to fall 20% from a peak, it qualifies as a bear market by the standard definition used on Wall Street. China was sitting at its edge. But the more interesting question is not how far China fell. It is where the money went instead. Here is the data. Analysts at Bloomberg tracked forward earnings revisions across Asian markets in 2026. For the companies inside China's flagship Hong Kong Index, analysts cut their earnings forecasts by nearly 3% compared to a year earlier. In the same period, analysts raised earnings forecasts for South Korea's KOSPI Index by 246%. For Taiwan's TAIEX, the revision was plus 58%. These are not small differences. These are markets moving in completely opposite directions at the same time, in the same region, in the same AI era. The reason comes down to what each market actually sells. China's major indexes are built on the old internet economy. Financial stocks make up more than 28% of the Hang Seng China Enterprises Index. Consumer stocks account for nearly 23%. Alibaba and Tencent, the two giants that once made every fund manager in the world want exposure to China, are losing momentum at exactly the moment global capital is looking for something specific. It wants chips. JP Morgan's private bank published its 2026 Asia Outlook and made the calculation explicit. Close to 30% of all global AI capital expenditure flows directly into Taiwan and South Korea. Not into platforms, not into apps, into the physical hardware that makes AI run. TSMC in Taiwan, Samsung and SK Hynix in South Korea. These are the companies building the memory and logic chips that sit inside every NVIDIA GPU cluster, every data center, every AI model training run. Without them, the AI boom stops. As a result, something extraordinary happened in equity markets. Taiwan and South Korea's combined stock market capitalization is now larger than India and China's combined. That is a reversal from just 1 year ago, a fundamental redrawing of the financial map of Asia. Now here is where the story gets complicated, because China is not standing still. Alibaba said it would overshoot its original 3-year capex target of 380 billion yuan on AI data centers. Its CEO told analysts the company is accelerating. Tencent's capital expenditure in the first quarter of 2026 surged 63% compared to the previous quarter. China's government is throwing billions into domestic AI infrastructure. Huawei is building chips. Alibaba's in-house labs are producing silicon. So why is the money still leaving? There are 3 reasons, and each one cuts deeper than the previous. The first reason is structural. China's stock indexes were built for a different economy. Hao Hong, chief investment officer at Lotus Asset Management, said something in June 2026 that captures the problem precisely. He said the indexes are measuring the wrong side of the economy. China's AI innovation is happening inside private companies, in unlisted labs, in government-backed research centers that never show up in the Hang Seng. The publicly traded companies, The ones investors can actually buy are still mostly banks, real estate firms, and e-commerce platforms struggling with weak consumer spending. The second reason is geopolitical. The chip war between the United States and China has a direct effect on investor confidence. American export controls prevent Chinese companies from accessing the most advanced semiconductors. TSMC cannot legally sell its most advanced chips to Chinese customers. That means every yuan China pours into AI infrastructure runs into a hardware ceiling that does not exist for South Korea or Taiwan. The third reason is the most revealing. Even when Alibaba and Tencent reported earnings in early 2026, they missed revenue estimates. Both companies are spending aggressively on AI, but intense domestic competition, a weak consumer environment, and the pressure of funding massive capex programs simultaneously is squeezing margins. Goldman Sachs and Morgan Stanley both acknowledge this tension. The AI investment is real. The payoff is not yet visible in the numbers. And global capital, which moves on quarterly earnings and forward guidance, is not willing to wait. Meanwhile, South Korea's KOSPI index surged 118% in 12 months before a recent pullback. Samsung Electronics rose 285% over the same period. SK Hynix, the memory chip maker, rose 439%. These are not growth projections. These are numbers already on the scoreboard. That asymmetry is what is driving capital allocation decisions in 2026. Fund managers are not making a political judgment about China. They are making a calculation. AI spending by Microsoft, Google, Meta, and Amazon needs chips delivered today. TSMC and SK Hynix can deliver those chips. The earnings show up immediately. The investment case is clean. China's AI bet is a long-term structural play that requires patience, tolerance for regulatory uncertainty, and confidence that Beijing's relationship with Washington will not deteriorate further. Not every investor has all three. There's a version of this story where China wins. Domestic AI chips from Huawei reach scale. Alibaba Cloud grows faster than anyone expects. The government stimulus finally pushes consumer demand higher. Chinese AI models reach commercial adoption not just at home but across Southeast Asia, the Middle East, and Africa, markets where American platforms face restrictions. That version is possible. Several serious investors, including Dale Nichols at Fidelity International, are already positioning for it. At roughly 10 times forward earnings, China's offshore stocks are trading at a discount to Taiwan at 17 to 20 times, and South Korea at similar multiples. The valuation argument for a rebound is real. But here is the honest conclusion the data forces you toward. Right now, in June 2026, the world's AI economy runs on silicon. Silicon is made in Taiwan and South Korea. The companies that make it are reporting record earnings. Their stock markets are at or near all-time highs. China is building applications, platforms, and its own chips, but the build-out takes time, and global capital does not wait. It follows the earnings that exist today, not the ones that might exist in 3 years. China is not losing the AI race, but it is losing the capital that funds the race. And in the short term, those two things produce the same result on a price chart. The question worth asking is not whether China's tech sector will recover. It will. The question is whether the global capital that left will still be available when China is ready to collect it.